Let's talk about the dollar. And 85% of the transactions are still done in the dollar. You pointed out in a recent speech that you think we've crossed the Rubicon. Are you comfortable saying what you said there, that for the first time in your career, you think we lose reserve status at some point?
I'm comfortable with it. That's my central case. As you know, Joe, I can change my mind. But yeah.
Is there a real threat right now to the U.S. dollar's status as the world's reserve currency?
Yes, there is a threat. It's an evolutionary type of process.
Are not going to be only temporary and transitory base effects, but because of the stimulus, because of the imbalance between demand and supply, they may be more persistent over time. So that's the risk we're facing.
Why are the best and most famous macro investors saying that we are about to see the end of the dollar as the world reserve currency? First, let's take a look at the state of affairs and what's happening right now. First, inflation is starting to pick up, and in April we saw around 4.2% CPI, a much higher CPI that we have seen in the previous 4 years. And we might see inflation pop up in the next few years. So what caused all of this? During the COVID crisis, the government printed out a lot of money to save the American public from this crisis. Looking at the M2, or the total money supply, that is the money that can be used and deployed by different entities, meaning consumer and businesses, it has increased 27% in the past year. And that's the highest growth of total money supply in the market that we've seen recently. M2 has been increasing linearly, but since the Fed printed so much money and injected directly into the economy, M2 has increased at 27%, while previously the average was at around 6%. But why did we see inflation in 2020 and we didn't see inflation in 2008 during the financial crisis? Inflation is when your dollar loses value compared to other things, meaning things get more expensive and so it takes more dollars to buy them. And money is a product like any other product. And so if you have too much supply of dollars, dollars are valued less, and so you have inflation in that case. But if supply and demand are at the same pace, then we might not see inflation. So when looking at M2, even though the average was around 6%, CPI was still at 2%. How can it be that the total money supply increased at 6% and the CPI hasn't increased as much? It has only increased at 2%. First, let's remember that inflation means that the dollar loses value. So the total supply needs to increase and the demand doesn't need to increase as much. And so in the past, the demand has increased for the dollar, either by being used by foreign entities that hold dollars or need the dollar to buy treasuries or bonds, that is, debt issued by the government, or they are just storing dollar as a store of value. But where did the supply of new dollars went to? It need to have increased some other asset values, and that's what happened. If we look at the total bond market, it has increased a ton. And even looking at negative yield bonds, they are at $18 trillion. So that means that there is around $18 trillion of negative yield bonds. That's nuts. Bonds were part of the equation, but when looking at the total market cap of stocks, it also has increased over time and it's at historical highs, even counting for earnings. That means that the stock market is overpriced. And that may be because there was so much money printing and dollar printing. So in some ways, there was inflation of some assets in the past, that is bonds and stocks, but not in CPI. CPI only measures common goods. So let's say that's coffee or food that you may buy or other services. So that didn't go up as much as the money supply entering the market. But then begs the question, why are we seeing CPI increase in this year compared to in 2008 or 2009 when there was a lot of money printing? So there are two parts of this equation. In the past, we're seeing the inflation of assets like stocks and bonds, And that's most of the money was going to. Whenever the central bank or the Fed printed money, you would buy bonds, increasing the total value of bonds, and consequently, increasing the price of stocks. The second part is that in 2008, when the financial crisis happened, a lot of the private banks were over-leveraged. That means that they were loaning a lot of money and they didn't have that much cash on reserve. If you look at this graph, you can see that they were loaning a lot of money and only had 3% in cash reserves. Whenever the Fed or central bank printed out money and gave back to these banks, they became under leveraged. So that cash just stayed in these banks. So they didn't go bankrupt. It didn't go directly to the economy. It just helped banks be stable. And finally, when we look at the increase of M2 this year compared to 2008, it was much, much higher. And the central bank injected directly that money into the economy instead of buying directly bonds. That helped increase CPI. Not only that, as we're gonna see in this video, the total demand for dollars decreased last year. So not only the supply increased, but the demand decreased. And unfortunately, we might keep seeing that in the future. We'll go over it. So let's go over the decrease of demand of the dollar. Let's roll back into last year during the spring. There was an equity meltdown because of the COVID crisis. And in the midst of that meltdown, the bond market went down 18 points a day. That means that the demand for treasuries or bonds went down significantly over a day. And at the time, a lot of people thought that macro investors like Druckenmiller were betting that the dollar might go down or something like that. But what actually happened is that in the midst of the Congress proposing the CARES Act, that was the act that the Congress was proposing to inject more money into the economy, and basically having a higher deficit and print more money, a lot of foreigners took out money from treasuries. That is, they were taking out money from debt from the US government. That's completely unprecedented. Let me go over again. In the past 20 years, when there was an equity market meltdown, people fled to treasuries or the dollar, as that was the reserve currency, and it was thought that these were secure investments. But this time around, people fled the equity market, and they also fled the bond market. They sold $1 trillion of treasuries overnight. And as you can see in this graph, there was a point that this market was illiquid, meaning nobody wanted to buy these treasuries. And so the Fed or the central bank had to print dollars and buy these treasuries so that the market became liquid again. And this is the central part of the problem. That means that you have $700 billion that the US needs, and there's no inflow of money. There's actually an outflow of money out of treasuries and out of the market. That means that the money needs to come from somewhere. And that puts pressure in the dollar because these treasuries were bought in dollars. And so foreigners had to use the dollar and create demand for the dollar. But now, instead of having a $700 billion inflow, we're seeing a $500 billion outflow out of the market. That means that the Fed or the central bank has to print out all this money, increasing even more the supply of the dollar. So not only demand of the dollar is going down, but supply is going up as well. But looking at the dollar index, which measures the strength of the dollar, it didn't go down since last spring. It went up a little bit and then down. What happened? At the time, a lot of that money went to technology companies, that is Apple, Google, Facebook, and the FANGs. And why did that happen? Because COVID accelerated that trend. But now that the COVID crisis is contained, we saw that money flowing out of tech or growth stocks into value stocks, and value stocks are elsewhere. They're not in the US. So we saw the dollar getting strength at the beginning, that is when tech stocks were valued more, and now the dollar is going down. And the dollar might keep going down as supply keeps going up and demand goes down. And that's the interesting part. So let's take a look at the thesis of the dollar decline. So twin deficits, that means trade deficits and government deficits, will tend to increase over time, as that's the trend. And as you can see, most of the debt created by the government will need to be bought by the central bank. And that means that there will be an increase of supply of the dollar in the market. There could be another option where the government increases interest rates, and so foreigners and other entities could buy treasuries or bonds from the government. But that seems increasingly harder because there's so much debt into the system, and so increasing interest rates could cause equity and bond meltdown. And the last time that they announced increase of interest rates, there was a meltdown. So it'll be increasingly harder to increase interest rates. And not only that, if they increase interest rates, the amount of debt that the government needs to pay will increase, and that can create a snowball in the future. And now there seems to be an outflow of money out of treasuries, whereas there was an inflow into treasuries. The government has around 8% deficit per year of the GDP. That means that the central bank will probably have to buy that, and there is more money coming out of the US. Not only the government deficit is really high at 8% per year, and now is the crux when baby boomers start retiring, and that will increase a ton the amount of money that the government spends. The COB projects that if the 10-year treasury starts at 4.9%, that means that interest rates are around 4.9%. The total amount that's paid in interest alone, it will be 30% of the GDP in a few years. That's how much the US spent in the COVID crisis last year. That's a lot of debt. That increases supply and decreases demand for the dollar. And that can mean that in 15 years, the dollar loses the world reserve currency status. And the Fed is enabling all of this. If we look at the treasury market, 60% of the bonds are bought by the Fed, and the rest is pension funds. The market would be completely rejecting this amount of debt into the system. So what could happen? We might see a structural change happen gradually. And we're already seeing that. Within Euro-Asia, a lot of commodities are not bought only by the dollar, but they are using yuans, rubles, and even the euro, as you can see in this graph. In fact, we could argue that the petrodollar was at the top in the 2000s when central banks held the most amount of dollar and has been in steady decline since then. In a strategic move, China in 2013 said that it's no longer their interest to keep accumulating treasuries. That has been happening for foreigners around the world. And in fact, China now holds less US treasuries than they did 7 years ago, and they're shifting away from the dollar as the whole world is as well. And now we're seeing a shift out of the petrodollar, a system that was started in the 70s by the combination of the US and Saudi Arabia, making sure that the oil was bought using dollars. In another video, I'll cover what it means when the dollar loses the world reserve status. I hope you guys like this video. Leave any comments and questions down below. I hope you have a great day. See ya!